Welcome back to the weekly market recap. Every single week, I drop a detailed breakdown like this, showing you exactly how I approached the markets, the setups I took, what worked, what didn't, and what I learned. And if you're not already following along daily, make sure to check out the channel. I post daily market breakdowns too, so you can stay locked in and sharpen your edge in real time. Let's dive into this week's price action. Monday, July 21st. Today was what many call a newsless Monday, but I was confidently bullish in my expectations from the start of the day. As an ICT trader, I don't just rely on news headlines. I focus on macro conditions and the algorithmic nature of price delivery. Now let's talk about why I leaned bullish. We're currently in a season of tech optimism with investor sentiment still strong due to AI-related growth earnings anticipation and interest rate speculation surrounding future Fed decisions. These create a favorable backdrop for bullish continuation, even on a day with no major news. But as ICT students, we know this. Even if the market intends to go higher, it must leave algorithmic footprints. So my job as an ICT trader is to track those footprints and align my setups with precision. Higher time frame bias. On the daily time frame, my bias was clearly bullish. Why? There was a visible fair value gap that I expected price to come down and rebalance before expanding higher. Moving to the 4-hour chart, I immediately spotted an inversion fair value gap, IFVG, formed from Friday's close, and that gap was rebalanced during Sunday's price action. I marked it out clearly along with Friday's high, which stood as the buy-side liquidity target. Waiting for the entry multi-time frame precision on the 1-hour chart, I saw a minor sell-side liquidity pool, the retracement from Sunday. The candle bodies lined up perfectly with the consequent encroachment of the IFVG. This gave me even more reason to watch that level closely. Then I dropped to the 15-minute chart, waiting patiently for New York session confirmations, the setup and execution. Just as I expected, the market came down and cleared that minor sell-side liquidity. Immediately after that, price created a fresh inversion fair value gap. I placed my OTE Fibonacci from the low of the day to the high of the London session. At exactly 9:30 a.m. New York Open, I placed my buy order inside the IFVG. No limit orders. Stop loss just below the IFVG. Take profit at the 100% OTE level. And what happened? Price respected the entry perfectly, never retraced, and ran straight into my TP. This trade didn't happen by luck. It came from deep understanding, patience, and trust in the algorithm. Everything lined up: time of day, liquidity, engineering, displacement, imbalance, and the entry model. Each element was aligned with ICT principles, and that's what made the trade high probability. This week in the markets was a clear example of why sitting on your hands can be just as powerful as pulling the trigger. Heading into Tuesday, I didn't have a strong directional bias. I sat down neutral, waiting for clarity to present itself. And eventually the market delivered. After the open price came up to test a previous fair value gap, showing respect for prior inefficiencies. Then it created a clean propulsion block and gave a decisive bearish market structure shift. That was my cue. I marked the propulsion block and noted the overlapping fair value gap, a high probability confluence zone. Then I pulled my OTE from the open to the low of the structure shift. The 62% retracement level of the OTE landed precisely within the fair value gap. Everything aligned. This wasn't guesswork, it was precision. I placed a sell limit at the 62% level, stop above the OTE high, and targeted the 100% extension, which lined up perfectly with a visible pocket of sell-side liquidity. This wasn't a scalp, it was a surgical strike. New York Open hit, and the market responded exactly as anticipated. Price retraced right into the OTE, tapped my entry, and without hesitation dropped directly to the take profit. No stress, no drawdown, no second guessing. The setup respected every PD array I'd mapped out. That's the kind of trade that reinforces discipline. On Wednesday, the conditions were different. I anticipated a potential consolidation type day, so I started simple. I boxed out both sides, buy-side liquidity and sell-side liquidity. My goal was to observe how price would interact with those areas. After New York Open, the market aggressively took out minor sell-side liquidity, which interestingly aligned with the previous session's OTE 100% target. That sweep triggered the next phase. Price printed a clean inversion fair value gap and quickly reversed. The algorithm had done its job, pulled in liquidity and set up the next move. From there, price climbed and cleared the London session highs, a minor pocket of buy-side liquidity. That was the final signal I needed time to frame a silver bullet setup. I measured my OTE from the day's low to the New York high. My entry was set at the 62% retracement TP at the 50% level, targeting the prior day's high, and my stop below the OTE low. The market respected every level. Price retrace filled my order and gradually pushed into my take profit zone with precision, no overthinking, no revenge trading, just trusting the model. Thursday and Friday, I stayed flat. There were no clear directional reads and no setups worth risking capital on. That in itself is part of professional trading. If the market isn't speaking your language, you stay silent. This week's main lesson clarity comes when you wait for it. The market rewarded patience and punished impulsiveness. If you're finding yourself forcing trades on uncertain days, take this as a reminder. Precision beats participation every time. Thanks for tuning in to this weekly breakdown. If this gave you value or sharpened your eye, hit like, subscribe, and share it with someone who's trying to level up their technical game using ICT concepts. See you next week. As I reflect on these past days, I realize the importance of maintaining discipline in unpredictable markets. It's easy to be tempted by quick gains, but true success lies in understanding the rhythm of the market. Each decision made should be calculated and rooted in knowledge rather than impulse. The charts tell a story, and it takes patience to read them correctly. Remember, waiting for the right opportunity is not a sign of weakness. It's a strategy that sharpens one's trading acumen. Thank you for joining this trading journey, and let's continue to grow our understanding together. Until next time, keep honing your skills and stay focused.